Imagine a company that is growing its revenue by almost 68% year over year.
Right.
A company that boasts this wild 84% gross margin. I mean, they're effectively printing money with a 44% net margin.
Yeah, pretty incredible.
But then imagine the stock market turning around and just punishing that exact same company with a brutal 31% drop this year alone.
Exactly.
Welcome to the paradox of Palantir. Okay, let's unpack this. Because how on earth does a business with those kinds of pristine fundamental metrics get slammed that hard?
Well, that massive divergence is exactly what makes this specific situation so fascinating. I mean, we are looking at a business with a market cap hovering around $295 billion, right?
Right, yeah, massive.
But to understand the severity of this drop, we really have to look past the pure profit and examine the volatility. Because the market data shows Palantir currently operating with a beta of over 1.5.
Wait, let's break that beta metric down into plain English for everyone listening. Because if a beta of 1.0 represents just the normal everyday swing of the broader stock market,
Yeah, the baseline.
what does a 1.5 actually feel like for an investor who is holding the stock?
It essentially means that, well, if the broader market takes one step backward, Palantir takes a massive leap backward.
Wow.
Yeah, it is 50% more volatile than your average stock. It just swings harder and faster in both directions.
Got it.
So when the tech sector gets even slightly jittery, Palantir gets highly turbulent. And, while their trailing 12-month earnings per share sits at nearly 89 cents.
Which is great.
Right, which proves they are highly profitable and making real money. But that underlying profit, it just isn't enough to shield them from these wild, magnified market swings.
Which I think brings up the core question for today's deep dive.
Absolutely.
Like, is the market wildly mispricing a generational artificial intelligence winner here? Or is this massive 31% drop just, the canary in the coal mine for a much larger sector-wide tech correction?
That is the million-dollar question.
Yeah. Because if a company's getting punished this badly, you would think customers are just fleeing. But the underlying engine driving that 68% growth tells the exact opposite story.
Yeah, the product driving all that relentless demand is their artificial intelligence platform, or AIP.
Right, AIP.
And to understand why the stock still commands a massive premium despite the sell-off, well, we have to look at why their customers just can't up and leave when budgets get tight.
I was looking at the operational leverage in the data earlier, and man, it is staggering.
It really is.
They are taking all this new AIP revenue across both the commercial and government sectors, and they're converting it into bottom-line profitability with just ruthless efficiency.
Yeah.
I mean, an 84% gross margin. That is almost unheard of outside of pure lightweight software apps.
Exactly.
So how do they scale that massively without their operational costs just ballooning at the same time?
Well, the secret to maintaining those margins really comes down to their competitive moat, and that is built entirely on something called switching costs.
Okay, switching costs.
Yeah, because Palantir doesn't just sell an application that you download, use for a few months, and then just cancel when you find a cheaper alternative.
Right, it's not a subscription to Netflix.
Exactly. They embed their software directly into the core workflows of massive defense agencies and sprawling global supply chains.
Wow.
Their platforms literally become the connective tissue for how an entire organization processes, analyzes, and acts on its data.
It's like a living organism.
Yes, exactly.
Like Palantir isn't just a wearable fitness tracker that an enterprise can casually take off and toss in a drawer.
Nope.
They're integrating themselves as the central nervous system of that organism. If you want to change out the software, you essentially have to sever the spinal cord of your entire data operation.
That is a brutally accurate way to look at it.
Or like trying to swap out the operating system of a commercial airplane while it's in mid-flight.
Right. You're just going to crash the plane.
Yeah. The friction of ripping that out and switching to a competitor is incredibly risky and, frankly, financially ruinous for the client.
And if we connect this to the bigger picture, expanding on that biological metaphor, think about how a central nervous system takes in millions of sensory inputs and turns them into a single cohesive action.
Right.
Palantir does that with data. They take all this siloed, messy information from a company's logistics, their HR, finance, and manufacturing departments.
Just totally disparate data.
Exactly. And they synthesize it so the actual brain of the company can make decisions. And because it is so deeply structurally integrated, the revenue it generates is what we call sticky.
Sticky. Meaning the customers are locked in.
Very locked in. And that incredibly high friction is exactly why Palantir generates so much free cash flow.
Okay.
Because when your customers literally cannot afford the operational downtime required to leave you, well, you don't have to spend a fortune on marketing just to retain them.
Right. The retention essentially pays for itself.
Exactly.
Yeah.
That secure, high-margin revenue allows Palantir to continuously pour money back into research and development, just constantly funding their own technological lead.
Okay, so if their moat is truly that sticky,
Right.
and their software is operating as this indispensable central nervous system, then the bears must be looking at something entirely disconnected from the actual product.
Oh, they definitely are.
Are they just terrified of the price tag? Because reading through the analyst notes and the sources we have for this deep dive, it is like reading dispatches from two entirely different realities.
The polarization on Wall Street regarding the stock is extreme right now. I mean, very extreme.
Yeah, because on one side of the tug-of-war, you have bulls making these wild maximalist claims. Like Wall Street analyst Gil Luria is on record explicitly stating that Palantir may be the best company in the world.
Yeah, that's a huge statement.
Not the best software company. The best company, period. But then on the exact opposite side, you have these severe analyst downgrades warning that the so-called rule of 145% may fail.
Right.
And I keep seeing this rule mentioned in the bearish data. What exactly is the rule of 145%, and why are analysts so terrified of it failing?
Well, to understand that, we need to first look at a traditional benchmark called the Rule of 40.
Okay, rule of 40.
Yeah, which is how investors usually measure a healthy software as a service company.
Right.
The Rule of 40 basically says that a company's revenue growth rate plus its profit margin should equal 40 or higher.
Okay, so it's a balance between growth and profitability.
Exactly. But Palantir's valuation is so sky high that analysts have created an incredibly punishing standard for them. The rule of 145%.
145. That's a huge jump from 40.
It is. They are demanding that Palantir's combined growth and free cash flow margin hit 145% just to justify the current stock price.
That sounds like an almost impossible standard to maintain over a long period.
It is historically unprecedented for a company of this size. And that brings us to the metrics driving the bearish downgrades. I mean, Wall Street is looking at a company trading at a price-to-earnings ratio of over 129.
Wow.
And their price-to-sales ratio is hovering over 56.
Okay, wait, let's put that price-to-sales ratio in plain English for a second.
Go for it.
That means an investor buying into the stock today is paying $56 for just one single dollar of Palantir's actual sales.
Exactly.
That is a massive premium to pay up front.
A premium that leaves absolutely zero room for error. I mean, a recent downgrade cited the extreme danger of the stock trading at 38 times its forward sales.
Forward sales,
Yeah.
meaning the sales they haven't even made yet.
Right, future sales. And the underlying psychological mechanism driving this fear across the market right now is a concept called AI CapEx fatigue.
AI capital expenditure fatigue, meaning what? Companies are tired of spending money on AI.
Close. It means investors are tired of watching companies spend money on AI without seeing the returns.
Ah, okay, that makes sense.
Because over the last 2 years, Wall Street happily funded endless capital expenditures for anything with the letters A and I attached to it. Companies bought billions of dollars worth of servers and chips.
Yeah, the whole NVIDIA boom.
Right. But now that honeymoon phase is over, investors are looking at these massive valuations and demanding to see the actual return on investment today.
They want the receipts.
Exactly. The market is suddenly terrified of companies priced for perfection because the moment a company misses earnings by even a fraction of a percent, it triggers a violent derating of the stock.
I hear that, but I mean, I have to push back a bit here.
Sure.
If the broader market is just suffering from a macroeconomic case of AI CapEx fatigue, meaning investors are mad at companies that buy chips but can't figure out how to monetize them, why take it out on Palantir?
That's the counter-argument, yes.
Because it seems to me they are executing perfectly on their end. They're the ones actually monetizing AI with that 68% growth.
Right.
Are they just a great, highly functional asset living in a suddenly nervous, volatile neighborhood?
Well, that debate is exactly what is tearing the analysts apart. Like, are they being unfairly dragged down by a sector-wide panic, or is that 129 PE ratio fundamentally unsustainable?
Right, it's up to tell.
And because the analyst notes are so wildly contradictory, the most logical way to cut through the noise is to follow the actual money. We need to see what the people with real skin in the game are doing with their capital.
Okay, yeah. Let's look at the flow. Because when you look at the insiders, the executives, the board members, the people actually running Palantir, The short-term data sends a decidedly bearish signal.
It does.
Over the last 90 days, insiders have been massive net sellers. We are looking at 13 buy transactions compared to 53 sell transactions.
That's a huge disparity.
Yeah, and that resulted in over 1.1 million shares being dumped by the internal leadership. When the captains are selling lifeboats, you usually start looking for the iceberg.
Very true. On the surface, that level of selling looks incredibly alarming.
But here's where it gets really interesting. The sources highlight this fascinating twist from the institutional side of the market.
Right.
If you follow the broader news feed, you'll see that famous value investor Michael Burry, the investor famous for betting against the housing market in 2008 in The Big Short.
Yeah, the ultimate contrarian.
Right. Well, he has been aggressively shorting tech darlings lately. He is doubling down on massive bets against major tech hardware names. And yet, amidst all this tech pessimism, he is explicitly holding on to his Palantir position.
What's fascinating here is how we reconcile those two seemingly contradictory actions.
Yeah, how does that work?
Well, on one hand, you have 1.1 million shares sold by insiders, but we really have to view that through the lens of high-growth tech compensation.
Okay.
Executives in these companies are heavily compensated in stock. So when a stock recently hits a 52-week high of over 200, it is standard practice for leadership to sell off portions of their portfolio to diversify their personal wealth.
Just cashing in some chips.
Exactly. It doesn't automatically signal a lack of faith in the underlying business model. It is often just scheduled profit-taking.
So taking chips off the table after a massive run. Okay, that makes sense. But Michael Burry, holding a stock with a 129 PE ratio, that feels like a glitch in the matrix.
It really does.
I mean, he is a notoriously critical, rigorous value investor who historically despises paying high multiples for growth stocks.
It is a massive anomaly for his specific investing DNA. For a value investor of his caliber to maintain exposure to a company with these astronomical multiples, well, it implies a deep underlying conviction in the actual asset.
He sees something others don't.
Exactly. He isn't holding it for a quick trade. He likely sees a fundamental mispricing in how the market values Palantir's moat.
Interesting.
And if you look at the technical data accompanying this institutional holding, the stock is currently finding a strong support floor in the 106 to 122 range.
Right, the bleeding kind of stopped there.
Yeah, the severe bleeding seems to have stopped, suggesting that institutional money is quietly stepping in to form a base.
Which means Palantir isn't just a leaf blowing in the macroeconomic wind entirely at the mercy of AI fatigue.
Not at all.
And they certainly aren't just passively sitting in their headquarters waiting for Wall Street to decide their fate. If you dig into their recent corporate moves, they are actively maneuvering on a massive political and strategic level to secure their ecosystem.
Oh, absolutely.
And these maneuvers might actually be the biggest long-term catalyst in the entire stack of research we looked at.
You're referring to their entry into the open-weight AI alliances.
Yes, exactly. The sources detail what is effectively a big tech revolt. Palantir has joined forces with absolute industry titans. We're talking NVIDIA, Microsoft, and Meta.
Huge players.
And they are aligning specifically to defend open-weight AI models. But before we get into the strategy, we really need to explain the mechanics here. What actually is an open-weight model, and how does defending it help Palantir?
Well, to understand open-weight, you have to contrast it with closed models.
Okay.
A closed model, like what OpenAI or Anthropic builds, is essentially a black box. The company keeps the underlying code, the weights, and the parameters completely hidden behind a corporate curtain.
So you can use it, but you can't see how it works.
Right. You can interact with it, but you can't see how it thinks or alter its fundamental structure. But an open-weight model like Meta's Llama makes those underlying parameters available.
Oh, I see.
Yeah, developers can download it, see the architecture, and fine-tune the weights for their specific needs without being locked into a single company's proprietary ecosystem.
So why does Palantir care which model wins? Why take a side?
Because the AI industry is currently fighting a shadow war over global regulation.
Really?
Yeah. There is a massive push by the companies building closed models to regulate open-weight models out of existence, mostly citing safety concerns.
Ah, so they want a monopoly on the tech.
Basically, because if closed models become a legally mandated global standard, a few massive tech companies become the gatekeepers of the entire industry.
Wow.
So by aligning with NVIDIA, Microsoft, and Meta to defend the open-weight movement, Palantir is fighting to ensure the future of AI isn't locked behind a single competitor's paywall.
Oh, I get it. They're future-proofing their software layer.
Precisely. Palantir wants its AIP software to be the universal translator. They want to be the integration layer for whatever models a company chooses to use.
Right.
If open-weight models remain legal and become the standard for enterprises who want control over their own data, well, Palantir has already positioned itself alongside the titans of the industry as a key stakeholder and the primary integration tool.
That's incredibly smart.
Yeah, they are building a defensive moat made out of strategic industry alliances.
And there are also these fascinating sort of speculative rumors in the data feed regarding deeper direct product integration with NVIDIA, specifically involving advanced models like Kimi K3.
Yes, the Kimi rumors.
For some context, Kimi is an AI model known for handling incredibly massive context windows, meaning it can process huge book-length amounts of data in a single prompt.
And that plays directly into Palantir's core strength. Palantir's entire business model is based on synthesizing mountains of unstructured data. If they are tightening their hardware-software integration with NVIDIA to optimize how these massive context models operate inside corporate networks,
then they're basically irreplaceable.
exactly, they are creating a technological lock-in that will be nearly impossible for competitors to replicate.
So what does this all mean for you as you listen to this analysis? Does positioning themselves as the defenders of the open weight movement actually translate into massive government and commercial contract dollars today? Or is it primarily a defensive shield against future regulation?
I'd say it serves both purposes, but the timeline is the key variable to watch here.
Okay.
In the long run, this strategy definitely secures their relevance. It ensures their software remains the de facto integration layer for the next decade of AI deployment.
Right.
But in the short term, Wall Street isn't looking at the next decade. Wall Street only cares about the next quarter.
Which brings us to the immediate looming horizon.
Yes. The sources point to a major upcoming earnings event centered around August 3rd. And let me tell you, the entire market consensus, all the analysts on both sides of this tug of war, will be laser-focused on exactly one metric.
Which is?
Can Palantir's commercial AIP revenue sustain that blistering 67% growth trajectory?
Because if they show any signs of slowing down, like if that commercial growth slips to 50% or even 40%.
If it slips at all, the market will aggressively question that 129 PE ratio.
Yeah, it won't be pretty.
That incredibly lofty 38 times forward sales valuation will suddenly look unsustainably heavy. The rule of 145% that the bears keep warning about will instantly shift from a theoretical caution to the dominant market narrative.
And the stock tanks again.
Yeah, we could easily see another severe contraction in the stock price.
So, to summarize the overarching view from the deep dive into all these divergent sources today, the final investment thesis really gives Palantir a bullish score of 7 out of 10.
I think that's fair.
You have an incredibly rare artificial intelligence software company successfully combining 68% hypergrowth with 44% net margins.
Right.
But this bullish setup is heavily reliant on a long-term horizon. The sources explicitly suggest investors need a 12 to 18-month target window to ride out this current valuation compression, absorb that insider selling pressure we talked about, and just survive the extreme beta volatility.
Exactly. You need time.
Because that time allows that AIP platform monetization to fully mature across their client base.
It is the classic investment setup, enduring short-term pain and volatility for the potential of long-term market dominance.
Absolutely.
And I actually want to leave you with a final thought to ponder, something that builds on everything we've discussed today about moats and ecosystem.
Okay, what is it?
Well, right now we are watching the market pour hundreds of billions of dollars into AI hardware, the chips, the servers, the data center.
Right, the NVIDIA gold rush.
But hardware inevitably becomes increasingly commoditized over time. Over the next decade, as those chips just become faster, cheaper, and more universally available, what happens to the global balance of tech power if the software layer ends up capturing the vast majority of the financial value?
Oh, wow. That's a brilliant perspective.
Yeah.
Because if the hardware is just the plumbing, well, the real power lies in who controls the water.
Exactly. What if companies like Palantir, the ones that actually integrate the AI directly into the messy real-world operations of governments, militaries, and massive enterprises, what if they're the ones who ultimately own the future of the industry?
It completely flips the current narrative. I mean, it means that a 129 PE ratio might not be a financial paradox at all.
Right.
It might just be the market struggling in real time to price the central nervous system of the next industrial revolution.